Welcome to Case by Case, where we break down investing one portfolio at a time and get to know the minds behind them. In each episode, we sit down with a small case manager to unpack one strategy, how it's built, and the philosophy that drives it. Stay tuned to understand how managers think, how portfolios come together, and what investors should really know about the top small cases.
So today we have Robin Arya from GoalFi. He's a SEBI registered research analyst focusing purely on quantitative factors to investing. And he's been in the finance field for the last 16 years with multiple roles in HSBC. And he's been there on the smallcase platform for the last 2.5 years. It would be an interesting conversation because we'll be able to talk about something which not many people actually focus on. So, welcome, Robin. When did you get into quants and when did you decide, okay, that's it, I want to get into it full time?
I think it's now a decade, more than a decade, 2015. So I started working in 2008, and it was a time of subprime, as we all know, the GFC crisis. So that was the start of my career, which, I'm sure how Claude is now kind of disrupting the new age fresh graduates. It's exactly the same way GFC kind of, disrupted our careers. So we had delay in joining and all of that happened. So that was the first exposure into how, equity markets worldwide go down. And just after a year, I mean, that was the year of my passing out, but it took a year to kind of into a stable job, which was 2009 when I got into HSBC, right? And from 2009 to 2023, where HSBC, as you mentioned, had a long career there. So quant work I've been doing from 2015 now. So 2009, the work started. 2011, you say start to earn some money so you can think of investing. So 2011 is when I remember opening my first Demat account with Share Khan. So it's now 15 years, of that journey. But algo trading, quant-based work started a little late. So 2015, 2016, I'll say. And from then on, I mean, I've been kind of working on it. 2018 is the period I remember I used to work full time, but told my boss that I want to start talking on factor investing on YouTube. And that time there was no influencers as such. 2018, I'm referring to 7 years ago. So my 2018 YouTube channel talks about all of this factor indices, back in time. So yeah, from now, say nearly a decade now, I'll say.
So when did you decide to go full time? Because I believe you are doing very well in your career as well. So why
Yeah,
does
so it's a accumulation of multiple factors, as I talk about multi-factors in our portfolio, same way life has multiple, kind of factors which kind of make you lead into a direction. So I think COVID is is the real reason of how I kind of really thought really deep into starting my own, because 2020 I was very unwell. 2021 I was very unwell when Delta wave hit and I was kind of on hospital bed for a long duration. And what happened the same time in 2021 September, account aggregator came up in India. So in the India stack, we already had solved UPI layer in payments, and we have solved Aadhaar for kind of identity KYC. Data layer was coming up next in terms of consent-driven data sharing. So I thought it is the right time where the ecosystem is maturing, and I was going through that post-COVID 6 months recovery. And I mean, I was like, life is just it's just one life, so let's kind of do something full time. So I was kind of contemplating from 2018 when I started YouTube channel. It took 3 years and then a COVID to kind of make you realize that just one life, so do it.
so you did the YOLO trade and get into investing itself for others as well? So, just into that conversation, like you passed out in 2008, you took 6 to 12 months to get into a job. I passed out in 2006, and for the next 6 months, I had a job, but there was no work to be done. So, we were sitting
Right.
on the bench. So, this is how markets are, the cycles are. So, tell me, say you've written goal fee. What does FI stand for in your case?
We really take care of say our health goals, our fitness goals. We say, right, we need a coach for our fitness routine, we need a dietitian for our food habits. In terms of money management, right, even though I worked with a big institution, I realized that a lot of my colleagues who are earning well, working in a financial institution, but when it comes to their own money, I think they are very poor in managing it. And say FI has a very simple meaning. When we started, everybody was talking about FIRE, right? Financial independence, retire early. And so FI also, or fee also, comes from financial independence. It also comes from financing your goals. So the whole idea is, how do you kind of structure your money management skills into a way that you're able to finance each of your goal, and that goal could be, of course, different goals for different life stages. So FI and fee, as we call it, Zomato and Zomato, I tell everyone in our case it is GoalFi and GoalFi, depending on, because we call ourselves GoalFians, so we call it GoalFi. A lot of people kind of say as GoalFi. So FI here is absolutely financial independence and financing your goals.
So interesting. So in your career, say when you were at a bank, were you in any ways involved in capital markets or anything, or it was totally separate?
No, it was a mix. See, I had a 15-year long career.
Yeah.
So every 3 year I was moving across service lines. So there was a part of my career where I was building a lot of systems for the bank. So I was never involved directly into investment management, but I was absolutely a part of a lot of systems at the risk side, at the analytics side, building systems for kind of facilitating that part of the business.
Maybe that is how you got into quants instead of every other way. So, see, a lot of people in markets start with different points, right? Somebody is a fundamental analyst, somebody is a technical analyst, somebody who just follows other people, etc. So, what was your start? Or
So
directly?
by education also, I did a master's degree in quantitative finance. So
Okay.
I kind of I'm a IIT Kanpur master in quant finance and risk management. As my kind of formal education in the world of quant finance. Prior to that, of course, I've done my master in computer science and all of that. So it was never quant on my say starting career. It was computer science from that direction, but statistics was always kind of something which was very kind of I was interested in. And when I started to see that, when I absolutely move into the world of kind of academic factor investing research, and as I said, my master's degree in confidence, that led to the realization that at our current Indian landscape, we are very heavy on fundamental ways of looking at things. We are very heavy on, say, only focusing on too much large caps, because that's where the story, because stories are not old in India. We are 25, 30 year old kind of markets. So we all know these stories of those big IT companies and big banks. But the world is changing very, very fast, and I think uh, of course we can discuss more into how the new age investments, which are not new in US, which are very, very kind of very prevalent in West from now 70, 80 years. But from an Indian standpoint, I think these concepts, maybe once we go deep dive in these concepts, we will realize that this is an untapped market. And at a fraternity level, say if you talk about say all 50 AMCs in a country which have active mutual funds, say index funds or ETFs, these products do not exist. And that is where we, I think, as small case, trying to bring those products which do not exist, and there's a gap to the retail audience. So all the say data driven strategies which say were only available in AIF form at very high ticket size, the whole idea is to democratize it and bring it to a retail audience via small case, for example.
So in this case, say for example, somebody gets into the market, we have inspiration coming from say somebody like I'm a RJ fan, somebody is some other fan. So who's been your inspiration to get into
Jim
quantitative
Simons.
finance?
Jim Simons. If you read a book called The Man Who Solved Markets
Right.
from Jim Simons, right? So Jim Simons is always the inspiration of all the guys working in quant side.
Yeah, everyone wants that CAGR. But the book did not
Everyone wants Medellin Fund CAGR.
the book did not disclose anything. That's the funny part of it. Yeah. So
Yeah.
interesting. So now we understand that how you got into quant, and given that at core you are a quantitative guy and a techie, it becomes easier for you to do it. Now, see, the reason I'm talking about this is even though I'm a techie by qualification, but never got into this part. But whenever I've come to get into quants, right? So there is a problem in understanding what is quant, what is factor, what is the different words which you all use, and then suddenly
Right.
statisticians get into words which we can't understand. Okay,
Understood.
so let me phrase you a simple question. How would you design a simple quant, or how does it work? What is quant factor?
I'll simplify it for you. See, all of our, even the broad market index, which is Nifty 50, is also a factor strategy. The only factor we use there is size factor, which means how do you constitute Nifty 50? If you have to construct Nifty 50, you will only look at market cap. When the market cap of the company is bigger, it has higher weightage in Nifty 50. So size is the factor. Market cap is the factor.
Understand.
Now, once you realize that you are investing in Nifty 50, you will very soon realize that you're actually not investing in 50 companies. Ultimately, the top 10 companies is what your returns would be
Yeah.
determined based on their returns. Because what we have given undue importance or too much importance to size factor there.
Yeah.
Now in India versus US, in US what happened, and in academic also, and if you look at India 25 years of data, mid cap and small cap have always outperformed over a big by a big margin. If you look at compounding returns,
Yeah.
rolling returns, whereas if you look at Nifty 50, it is usually large cap. So, like size is a factor in Nifty 50. What we say size will be given enough importance because we would like to have large cap in our portfolio when needed. But why not? Why only look at size? Let's look at say quality. Now, how will someone say what is quality? Of course, the books may say companies, balance sheet. If you further go, you may say ROE of the company, free cash flows of the company, dividend yield of the company. That could be three parameters the academic may say. You may define your own parameters basis your research. Something like value. Academic may say, okay, price to earning multiples, price to book multiple, earning EV by EBITDA margins, all of that, right? These are all different factors if you think about it. So when you construct Nifty 50, you're not thinking about price to earning multiple or EV by EBITDA margin or ROE of the company. You're simply thinking market cap. What we are saying, size is just one factor. Think quality as a factor. Think value as a factor, which I just explained. Now, in very, kind of that's a very fascinating fact that in India, because we are kind of a retail market, speculative market, liquidity is very limited. Momentum as a factor, right, has really outperformed in India, and there are reasons why it would. Now, momentum, of course, a lot of studies have done in why momentum work, why it does not work in kind of developed markets versus in emerging economies. So we'll of course can deep dive. The whole idea being when we construct our portfolio, if you have to keep 50 companies, like the case of Nifty 50, size, quality, value, momentum, and couple of more like maybe growth. You may want to look at EPS growth. You may want to look at say sales growth, revenue growth. So you define parameters, not just we define NSE as a kind of index. NSE, if you go to niftyindices.com, you will see wonderful indexes being laid out by NSE itself, and they have been requesting AMCs to launch index funds on the top of it, mutual funds on the top of it. But unfortunately, our industry is lagging where they are only kind of everybody focusing on launching a kind of large cap, mid cap, kind of index funds and very so out of 300 index funds, I was checking the count, out of 300 index funds and 300 ETFs in the country, we have only 5-6%. So only say 15 factor funds, and that too single factor funds. We say only on momentum. And problem with all of that is, right, I mean, of course, I've discussed with a couple of my colleagues also in the past in some of the similar settings that all of these factors will have cyclicality behind them. And that's where we see a lot of LinkedIn kind of, push happen between AMC managers and quant managers where they say, what happened to low volatility? Why it did not perform? So the whole idea we are very focused or we are doing research on is multi-factor investing is the way to go. Do not rely on size as a factor. Do not only rely on momentum as a factor. Make your portfolio a mix of factors and basis the market cycle you are in. If you are in a bullish regime, you play a different kind of combination. If you are in a bearish regime, and that responsibility lies with the fund manager or the model portfolio, manager to decide or to do a lot of kind of test and all of that to ultimately get to a sweet spot which can be explainable to the end user. At the same time, create a risk adjusted return for the clients.
So interesting because I think there are some which have been there, and I think one of the earliest ones was a PMS by a bank only, which used to run a quant fund. The bank itself, they shut operations in India, and the fund also lost. But given that, because we tend to compare every factor to perform in every cycle,
Yeah.
right? So because of that reason, a lot of quant funds have not really picked up, and people don't understand what is quant, right? So for example, we don't understand what is content factor. Now, when you said okay, factor is this, and then is the whole thing which becomes a quant. Like now we've understood about what is factor and what is quants, right? So there are multiple factors, and then you make it up on your quantitative way. This is the way we create a fund. Now let us make it one more step. Say for example, pick any one of the factors, okay? and try to simplify how would a new entry come in, right? Say suppose it's a 50 stock portfolio and it is value or growth or momentum. How would you take the process to get a stock of 50 stocks or a replacement? That would be interesting for us.
Yeah. So I'll go with how a retail audience can check for themselves so that they can construct if they like. And absolutely, we are here to kind of give them a ready-made product if they are struggle to kind of do it themselves. So everybody should go to a website called niftyindices.com that basically has a section called broad market indices, which has Nifty 50, right? Nifty 500. Then you have a sector indices, all pharma, auto, metal. There's something called strategy indices, which is also called smart beta indices. Now, if you go there, you will see that there is single factor index there, such as Nifty Alpha 50. There's a two factor index there, such as Nifty Alpha Low Vol 30. There's a three factor index, Nifty Alpha Quality Low Vol, four factor Alpha Quality Low Vol, and momentum, all of that, right? So there are combinations made by NSE for us to do academic research on and also to create new baskets. Now, if you go to any of these baskets, you will see in India that all data of all of these index exists from 2005. Mostly all of them, 95%. Few indices are available from 2009. Some data is available post GFC, but say 95% of all index, whether it is quality index, value index, momentum index, alpha index, all exist from 2005. Now, different index have different rebalance frequency. When I say rebalance frequency, it comes to your point around how do we change or what is the process of screening. Everything is mathematical in nature, but from a retail audience, how do they do it? Now, for example, there's an index called Nifty 500 Value 50, which means top 50 companies out of Nifty 500 which are showing lot of right value. They are at right valuation. Simply value would mean what they take. They take price to earning. They take price to book. They take EV by EBITDA margin. And suppose depending on the sector, you may want to choose kind of different parameters depending on whether you are working for you think of an NBFC perspective, you look at different parameters. You're looking at IT, you look at different parameters. All that work is done for you. Even we come at second stage. The first work is done for you. The index will only rebalance once in 6 months. However, the fact sheets get updated every month, which means as a user, you just go to niftyindices.com, go to strategy indices, check these strategy indices, open their fact sheet. You will see all of the holdings which are present. You come back next month, you see how the weightage changed. For example, if you look at Nifty 50, Nifty 50 will mainly be what? Financial services and IT. That's what Nifty 50 will be. 10 years ago, maybe it was slightly different. 10 years from now, because of Anthropic and all of that, IT may not be a major component of Nifty 50 maybe. Again, maybe back to manufacturing as one of the capital goods as one of the component. However, the beauty of factor indices are, you will see that when automobile are moving, automobile have the kind of more weightage. When metals are moving, it will have the more weightage. Now, which factor to choose? That's something you may decide basis your rebalance preference and you resonating with something. Now, somebody is a momentum player. They would really like to be in the market when market is moving in a bullish phase and want to move it to cash when markets are not in a good kind of momentum phase. They want quicker rebalance once a month, once in 3 months. So the standard indices which is available for momentum updates every quarter. So every quarter the name shuffles. What is the formula? If somebody wants to go deep, they can absolutely look at momentum is price action. It will only look at the last 6 months to 12 months rolling return and all of that, and it will give you the top 30 stocks in that fashion. Now look at value as a say index. It doesn't rebalance that frequently. It is the same rebalance frequency as a Nifty 50, which is 6 monthly or yearly, which means you're buying something at the right value. However, to avoid you being in a value trap so that you are not ultimately buying something which is actually real cheap and not cheap because of it actually has lost value, then you should combine the factors. Look at quality as a parameter, which means if a quality company is 30% down, you don't panic in such market fall. You enjoy the fall because you know that the company I am putting my money is a quality balance sheet company and it is 30% down. So it is the right company to put my value factor as the name plus quality is already added. So that's one part of the business. there's a very beautiful index there called mid small quality momentum 50. So mid small 400, mid cap
Okay.
150, small cap 250, which means 400
Okay.
companies as a universe.
Okay.
In mid small cap 400, there is a very beautiful index called quality momentum 50 or
Okay.
and quality
So
momentum
mixture of
100.
both.
So basically, what they're trying to say in mid and small cap, where there's a lot of alpha opportunities, you have already filtered the quality names. So you are coming with 100 names out of 400 by design. You are only picking 50 out of it, which are in momentum. So you basically are not compromising on quality. You're not compromising on, say, momentum as well. However, as I said, in India, there is no index, there is no ETF to track it.
Exactly.
There is a benchmark index made for it. But do we have a product available in India? No, there is no product available in India. That's how I think so our job, so your job, my job becomes important. Either the AMC and also why it happens. See, AMC is solving a different use case and we are solving a different use case. What AMC is trying to do is penetration. They are trying to do 100 rupee SIP. Now, if I have to do 100 rupee SIP, it is very I am trying to go to tier 2 tier 3 cities and I'm going to my say domestic staff who are first time coming to the markets. I want to give them very simple explanation that okay, I am just putting your money in top companies of my country. So they know, okay, I see the branches of the bank everywhere, so they can relate to it. So I understand right product for them. But for people who are our users, who are say small case audience, informed users, they should now graduate. They should now graduate from this vanilla index where the job of AMC is not alpha generation. I have spoken to so many AMC fund managers. None of them told me that they are there to generate alpha. They simply say they are there to get more SIPs. Their job is to get more SIPs. Our job is to get absolutely alpha because our audience is informed audience, and because we, as say even platform, as a small cap platform, doing such a fantastic job of bringing these strategies out. Now AMCs are forced to kind of put
Yeah.
smart beta strategies out. They are now also putting smart beta strategies out because of retail audiences asking for it. So for same method we use now something which is proprietary to us. So I use 78 factors, for example. We don't know do the 5 6 factors. There are 78 factors which we use. Of course, we have our own
Okay.
internal research engine, our own models. Every day, a lot of things get churned. Everything and what people confuse all the fundamental research analysts what they kind of think of quant investing is that we do not take care of fundamentals as such, or we do not take care of the management quality as such. I'll tell you, with this new age cloud and all what is happening in this world, everybody is responsible. I mean, for example, it's so powerful now, even when we do a pilot at our site, so powerful that whatever the management has said in the
Yeah.
last 10 years, which is available on the con calls, everything can be fed to a machine, everything can be made into a quantifiable model. It becomes a factor then. So it's never that the quant guys are not looking into fundamentals or balance sheets or management quality. They do. However, most used or common factors are the common ones like momentum quality, and that's why we usually think it is too technical. But at the same time, when we create multi-factor baskets, for example, we create at least 3 to 4 factor baskets
Yeah.
where in India investment landscape, there is no fund house in the country which has 3 to 4 factor basket. Only max 2 factor baskets. And most of them are single factors. Even though I said that out of 300 ETFs, only 15 ETFs exist for factors, most of them are single factor. And single factor baskets are again recipe for disaster. Reason being, like size fails at times. Similarly, momentum fails at times. Similarly, value fails at times. So it's very important that we create 3 4 vector baskets, and I'll tell you a very good research done by NSC, and we can of course quote the link once we have this live. uh, Multi-factor baskets are less volatile in nature. So my worry
Yeah.
is we think Nifty 50 is generating 12 13% CAGR. If you think broadly, it comes with a 20% volatility, which means somebody to get 12% has to go through 20% up and down in a year. Even in the best of years when Nifty makes 2023 kind of returns or even 2020 kind of returns, so somebody may, in Nifty 50 might be showing positive return, but somebody sitting in Nifty 50 might be showing huge volatility. Multi-factor on the other side are comes at lower volatility. So they comes at 17% volatility, but gives 3-4% alpha. So that's where I say that low risk does not mean low returns. It is how the
So,
portfolio is constructed.
so very interesting way to explain instead of saying sharp ratio, this ratio, etc. Because that is how most of the quant people talk when they talk about this. And like say
Right.
Nifty indices has amazing number of indices. It even has say leveraged ones, short ones, etc. But ETF as a product doesn't go up because the fees is very low. And say
Correct.
being on the sell side, we've realized. So fund manager simply says my job is to not take a risk which is bigger than my career. Okay. And
Yeah.
second is in 1 year you are in the stars and then you are seeing the stars. So you need to be in the middle because it's a
Yeah.
very large field.
Yeah,
Uh,
yeah, absolutely.
So
And see, it will take time. See,
yeah,
I am not. I mean, I understand their viewpoint when I speak to these AMC fund managers. I understand their viewpoint. The
yeah,
idea is we are maturing as a country. We need more
exactly.
liquidity in our country. So I'm sure there will be a time when these three, four factor strategy indices will become the mainstream, and we are
So
here to do. We are here to do that.
exactly, very interesting because say when you went into factors, I was always going into the next point, which you've covered a bit. That say, see many a times we go with one factor. So say momentum worked really well post COVID. Okay, then say at one point of time there was quality which was working in
Yeah.
2018, 20, etc. So give us some insights into how do you look. See, because in your case, if you're running a multi-factor portfolio, there's a lot of discretion at your hand, right? Because when we hear quant, it seems like it is automated. Like you press a button, the portfolio comes and the manager is doing nothing, right? So give me your perspective that how do you think about multi-factors and cycles?
Yeah, so I'll give you an instance where one of I mean I work out of Hyderabad. There are research houses in Hyderabad, and we were invited for a Google launch. They launched their first ever biggest kind of incubation in Hyderabad, say 2 months ago. So they invited some founders, and I was one of them. And we were talking about AI and Google AI. So the whole point all these tech companies are trying to make was tech will be available, AI will be available. It is us human who will decide the guardrails, who will do the review, who will do the policies, who will kind of do the check boxes. So we as quant fund managers, or at least from I can talk about our side of the business, absolutely model gives an output. It is our responsibility that if a model gives short PSU bank and it's one of the largest PSU of my country, will I be shorting it just to make money, or I have to also think about me as a country, right? So that's where all of this. Of course, we deploy a lot of AI and machine learning and all of that as part of our ongoing research work. But it comes to portfolio construction, it comes to small case construction, and when it is real money, if I have hundreds of crores of money invested of retail people with me, I can't take the decision of okay, churn the entire portfolio and replace it. That's how it doesn't work. So the way we have done is we have six strategy and dice. See, we have six baskets. If you see this way, six small cases. Three are pure rule based. Three are discretionary. If you see this way, the
Okay.
reason we have done it is to kind of match to the user persona. Few people really like to be rule based. They
Yeah.
kind of subscribe to you because they do not want your bias in it. And some people pay for fund manager bias, right? There is
Yes.
there are two parts to it. So even though for example, momentum strategies can have a rule based system, very easy, because either you are in sitting in
Yeah.
momentum or you're sitting in cash.
Yeah.
For example, alpha strategies can be pure kind of lagged. For example, now things like for strategy, we have something called growth and value flexi cap model. Now, it absolutely a three-factor strategy. We use growth, value, and quality. But it's a quarterly rebalance, for example,
Okay.
strategy. Now, every quarter, and especially in the current kind of environment we are in, with a lot of tariffs coming in and kind of Trump tweeting whenever he would like
Yeah.
to, it's very important for us to have a human layer on the top of that model to decide it's a effect of a tweet, it's a behavioral factor which is impacting it, or it's actually a real impact.
Yeah.
So portfolio like growth and value flexicare, which is say one of our very successful product, and very well accepted and very well kind of seen the cycle of drawdowns and recovery, has a human layer to it. For example, at the same time, academically, multi-factor baskets do not go in cash. They always
Mhm.
remain invested.
Yeah.
Multi-factor baskets do not have a concept of hedging with gold and silver. academically. But however, we had to create a balanced multi-asset basket at our side, so that how we kind of put it to our clients that usually we say that one basket is enough, because we do not want them to have a lot of holdings in their portfolio, to avoid kind
Yeah,
of a lot of
otherwise it's the
noise.
same.
It's the same, right? Ultimately, you're buying a mutual fund with
Yeah.
50 companies, doesn't make sense. And we as a research house play a concentration game. Of course, we have our own risk framework, like we do not go above 20% in a particular company. We do not go more than 25% in a sector. So we have our own construction rules, and everything is defined in our methodology kind of section, that how do we construct all of these kind of capping of risk and sector capping and all of that. However, what we have realized that usually in our side, a combination of these two kind of strategies, for example a multi-asset kind of strategy, which can help retail client to survive this pain, because growth and value is pure equity basket, which means that it will have a
Yeah.
a good drawdown as well. Now for retail audience who are say new to us, if they kind of join them with balanced multi-asset, and with multi-asset having the flexibility to, and multi-asset is a rule-based basket, no kind of human intervention. It's a rule-based basket. So a combination of a rule-based basket like balanced multi-asset, which has a mix of large cap, gold, silver, whenever needed, right, depending on the market cycle, and growth and value, which is slightly discretionary in terms of governance layer, usually worked out best in our case. However, yeah, I mean, happy to take questions in detail if you'd like to in any of these.
Yeah, so basically you are not trying to factor only in momentum, say, which has worked. You are using multiple factors, and interestingly, you've put multi-asset also, because this is what people don't do in the quant side of it. Because the same rules don't go to understand when to buy
Correct.
gold or when to buy silver or when to buy
Absolutely.
bonds, etc. So you've tried to meet it together, and interestingly, you have one part which is rule based and one part which is where you have the discretion,
Correct.
because this is where it has been a problem for a lot of quantitative funds, because they were not very clear in themselves. Ki, boss, we don't want any say any discretion from the
See,
fund
idea
manager.
is alpha index at an index level may have 30 Nifty 200 alpha 30 as an index may churn at the quarterly rebalance and remove all 30 companies and add
Wow.
new because of the rule, right? That's how. However, when we put real money on table, right, crores and crores of money, it's a tough game to be. Plus, alpha, if you look at as a factor index, is even higher drawdown. My job as a fund manager, as a model portfolio designer, is to reduce risk, to reduce volatility, and only 3-4% alpha is what we say aim for, because a 3-4% alpha over 10-year period is double compounding. 1,000 become 3,000 at 12%. It can become 6,000 at 16-17%. So 3-4% alpha can double your money, and if you are able to take lower risk for the same kind of effort, then that's the right place to be.
So in this case, say, do you have a defined universe in all cases? You
Yeah,
focus
yeah,
on.
yeah. So see, we would love to have a bigger universe, but in India, liquidity is a challenge. So
Yeah.
Nifty 750, which is Nifty
Okay.
total market, is our max cap. We do not go beyond Nifty 750.
So, any views on the data available to do your analysis? So, have you been building your own data or using what data or?
Yeah, so we have been building all of our internal tools. Our parent company is a tech firm, and we have been kind of building. I mean, with the partners we have in terms of data providers. So we have been doing. I mean, nothing has been kind of put out yet for public consumption, but all of the, so we also are academic partners with very good institutions in the country, and some professors from very premier institutes are mentors on the platform. So we are doing academic research also on factor
Okay.
investing. So we hope to also publish some papers on finding new factors, all of that, right? So that's our kind of academic work, which we are trying to do. From a data perspective, we crunch all of our own data. So we of course take it from the source, either from a data provider or from the source itself, the company balance sheets, right? That's the actual source of data. So we take it from the source and have processed, say, data from the inception from 1990s to now, and we have
Okay.
all of it in our side. Yeah.
Okay. So, you've built your own data also to make it easier for you to work. Because this has been the problem earlier when I've spoken in my sell side days with a couple of fund managers who are doing on the con side. कि बोले यार डेटा ही नहीं है तो करेंगे क्या right?
So data is missing. Data is absolutely missing because
Yeah,
what was Nifty 500 now and what was Nifty 500 in 2001 is very
yeah, it's
different
not
because
available.
of
Yeah.
recency bias hota hai, right? You will only keep the winners with you. So that gap is there in India. But I'm saying since we're starting 2.5 years now, and now I'm very happy from a future perspective. I'm
Yeah.
very happy from my clients who are coming after COVID now because they have the time with them. We have the right tools and right data and data kind of, in detail now. So if we are building something for the next 10, 15 years, even we are in a good place, even our clients would be in good place.
So interesting. So, for example, now in this case, say at current point of time, right? What do you think is a factor which should be avoided, right? Say, for example, say in 2018-20, you focused only on quality and it worked even when the markets were down. So, what is a factor to avoid? See, everyone tells you where to put money, what to avoid, because you are the one who understands what factor may not work right now.
See, low beta doesn't work in India. Now it's a very,
Okay.
very, very, unfortunate thing to do. I mean, see, think about. We always you think about, say, FMCG is a space,
Yeah.
it's a safe space, it's a defensive space. See, in India versus very different to US. In US, the low wall factor really outperforms. It has lower
Okay.
drawdown, it has lower kind of,
Okay.
higher sharpen, all of that, right? The technical terms. In India, Indian market is speculative in nature. Indian market is retail oriented. Indian market is not passive like ETFs of the
Yeah.
US, which means Indian markets low vol won't work. But Academy will teach you that. They will teach you low volatility will work. That's how the factors kind of strategy which are made on low vol will fail. And then everybody will come on LinkedIn and why low vol is not working because it is not supposed to work in India. In India, high beta works. In India, kind of so low vol doesn't work in India because FMCG and all of these sectors which are considered to be low vol in nature by design, they already they're already priced in. You
Yeah.
don't find cheap, you don't find a low price to earning multiple, right? So they're already priced in. And if you're paying higher price anyhow, you can't make money. So I'll say I am not against any factor. We need to have a mix of factor.
Yeah.
That is how our kind of orientation is. And review every 3 months, 6 months. Yearly is very much needed. There is no point in doing active management if you're shying away from rebalance.
Okay.
That's how I put it.
So, to sum it up, how would you say about your, say, quant investing career till now? And how do you look forward, say, with AI coming in? How does it become a factor and how
So
do you look at
AI
it?
is a blessing. I'll tell you, AI is a blessing for all of us. I think we are over panicking, and I'm sure all our IT companies also will adapt it very soon. There's a lot of power. See, it's an enabler for us. As a research house, if I have a 50-member team, it suddenly sounds like 250-member team
Yeah.
because everybody has become so productive
Yeah.
and everybody we only have to, as I mentioned about my Google startup experience, that and we are a part of Google for Startup cloud program and all of that as part as a startup. So what I realize it see it is a great power to have, but we need to really make sure that we utilize it in the right ways, right? In the right ways, and future is absolutely very bright for con-based investing. Academia ways of looking at factors versus real implementation differs because Indian markets are not at a stage where US markets are, and all
Yes.
of this research, Pharma French, and all of this research is done on US markets. So it's very important for people like us and young guys who are actually working in, say, all of these institutions to continue researching on Indian context of these factors. That's where the industry is not doing right,
Exactly.
and kind of calling out that it doesn't work. It won't work because the nature of the markets are very different in both the countries. So that's how you have to tailor it to our own country landscape.
Yeah, something which works in India may not work in Taiwan, where the index has only few stocks, right? So it has to be.
Absolutely.
So
Correct.
very interesting conversation. So you simplified quant and say looking at multiple factors and trying to simplify it and have a open approach also going forward, which is generally a problem in this industry because things are evolving as well. Now we go to the next part, very important part actually. You have multiple small cases. Which is a small case which you suggest? And please explain a brief about it as well.
As I there are six strategies out there. Five are actual factor strategies. One is a theme right, which we have of capital markets because we belong to that industry, so we resonate it with. We know that
Yeah.
depositories are getting benefited, AMCs are getting benefited, NBFCs, getting benefited. So we that's it. But if you talk about what happens with a theme, I'll just cover theme in a bit so that
Yeah.
I'll say why no immediately, because theme has a long-term game. With retail audience, it's very difficult to retain them for 5 years because themes only play out in a
Exactly.
cycle. You may have a theme but it may not play out every year. Now for a new investor, as I said, I think earlier, it's always a combination which matters. So quality is a layer which is taken care by us, right? Quality is always taken care. We do not invest in any company which is fails on quality parameter, which means even if there's a drawdown, even if it is a 3 month rebalance, it's a blessing. It's a
Yeah.
blessing. It's a blessing in disguise that you can put more money. So growth and value flexi cap model is capped at Nifty 500 because of
Okay.
the we have another one which is 750 at alpha side, but growth and value is capped at Nifty 500. It's called growth and value flexi cap model, which is basically three factor: quality as a underlying layer, growth and value. Now what we try to balance there is, usually growth companies comes with very high valuation.
Yeah.
You won't easily find growth companies with low value. So what we're trying to balance there is, half of the portfolio is growth oriented, half of the portfolio is value oriented, so
Okay.
that you get both side of the
Balance.
kind of market in the, and it's a quarterly rebalance. So every quarter you are at a very strict kind of checks and balances that company which is in growth continuing that growth, otherwise market really kind of give
Yeah.
punish you in case you are not. Plus value as a factor in India, if you see current market also, all of the PSU themes, capital goods, very undervalued names, and the right space to be, right, all of these. So value is a factor also if your single factor is working very well. So growth and value. But I'll say in current market cycle, a balanced multi-asset really stitch in very well. It gives that kind of buffer to clients, to subscribers. First of all, if they're in first time, they do not really see that kind of drawdowns,
Yeah.
because it also can move to cash, it can move to commodity, it can move to debt. So a combination of, I'll say, I'll not pick one, to be very honest with you, a combination of and there of course there are other like momentum and alpha on our side, but for the conversation, I think for the context and for the current environment, I think a combo of balanced multi-asset and a growth and value works really well.
So, what are the number of stocks in each of these small cases or
We
weightages?
have a cap of 15. We do not never go. We have never gone above 15. We have
Okay.
never come below 7. So our sweet spot is 12 names, 10 to 12. So if you
Okay.
combine them, they become 18 to 20, 22 max,
Okay.
even less.
So, do you
So
have a cap
yeah, yeah.
on a single stock exposure or a sector?
20%, 70% is the cap on single stock, and 25% is the cap on sector.
Okay. And it is not equal weight or it can be
No,
different.
it's a factor based, no? So it's a factor driven. So the weightage will be depending on the factor weightage. Yeah.
Okay. So, interesting. So, it is Nifty 500 stocks balanced on both. And
Yeah, balanced
somebody,
multi-asset is large cap model. We have a balanced multi-asset large cap model. So it's only Nifty 100 plus gold and debt. So Nifty balanced multi-asset is a large cap model. Growth and value is a flexi cap model. That's all two models we have.
so this is pure equity. This can be a mixture of everything.
Yes.
Interesting. So now that you've covered all this, can you give us some books or any other resources which someone should read, even for your work or any work on quant investing, etc.?
So if you are technical in nature and you like to explore, we all said that start reading about Jim Simons in general, about Medellin Fund in general. But I think for people to start with, I think all these Morgan Housel books are very good. Psychology of Money and all of that books are very good. And depending on which side you want to be.
On the quantitative finance side, say whatever factors or
See,
factor
I really
investing.
want people to read. I had few books I can pull up and show you. I would really like people to read, books which are on behavioral finance,
Okay.
because that is the thing which is missing in even new fund managers. So I was just kind of pulling one book from here. See, there's a book called Misbehaving.
Okay.
So this is a very interesting book. It is kind of from the point of Dale Kahneman and the kind of genius who started
Yeah.
behavioral finance
Yeah.
world. So it's the making of behavioral economics. It's a very very beautiful book, and yeah, psychology of money and Jim Simons, and there's also a book. So what everybody should do, even though you want to build your career in quant or say want to learn markets, even technical chartist, kind of technical books which kind of help you understand how technical charts are formed, from very basic book like Joseph J. Murphy. The I think the art and science of technical analysis and all of that. I think these are very good starting point for retail investor to make sense of what they read in print media, what they kind of listen to us in all of our weekly catch-ups. So art and science of art there's a guy called Steve Nisson, Candlesticks, Japanese Candlesticks, kind of book by Steve Nisson. I think these are all wonderful books if they would like to read.
So very interesting. So finally, we come to know about what is quant way of investing, because we've generally been focused on only one side of the market and looking at multiple factors, right? Because all of us get used to one style and stick to one. And data driven is very interesting because we've always been narrative driven rather than data. So lovely talking to you, Robin. All the best, and hope to
Thank
see
you so
you do
much,
more.
Naresh, and thank you, Smallcase team, for having me. Yeah, thanks. Cheers.
Investment and securities market are subject to market risks. Read all the related documents carefully before investing.